I am Dawn Keller, and I am a real estate investor and multifamily syndicator. I appreciate y'all joining this evening for our quick 30-minute education series, Money Matters. I try to do a different topic every time. So tonight we're going to be looking at a really fun topic of how to analyze a multifamily investment deal. But before we get started, for anyone who doesn't know me or is not familiar with kind of what we do, or just to give like a little background on this, I essentially help people create passive income through real estate investing. Um, don't worry, I'm not going to sell you anything tonight. This is for educational purposes only. I just like sharing this with other people because multifamily investing is something like syndications. Like I didn't even know that existed, or I didn't know how it worked just a few short years ago. And I was looking for a way to put my money to work. Actually find that a lot of people are really want to invest in real estate. They don't have the time. They don't have the time to find their own deals and manage their own deals. And that's where this kind of checked all the boxes for me. Is I was looking for a way to put my money to work, but really being truly hands-on. I did a single family flip several years ago, and it's a lot of work, and a lot of people don't have the time, but they want to enjoy all the benefits of the rental income, that passive income. So this is a great way to do that, is through multifamily investing, where you can still enjoy those benefits of real estate, the owning real estate and getting rental income, that passive income stream, without really being a landlord. So essentially what we're doing is we buy apartment complexes, and mostly in DFW. I think I've got several people on here tonight from the area. And we, let's say that all of us on this call tonight, that we all co-owned, we pooled our money. A syndication is really just a group of investors that are pooling their money to buy a larger asset, right? So these are 10, 20, $30 million properties. I couldn't buy one of those on my own, but if we collectively all together pooled our money, we could buy that. And so that's what we do, is we find the deals, we set them up. We've got an LLC that owns the property, each individual property. And then it's something that investors can look at and see if they like the deal, and then they are going to co-own this property with us. They will be a member of the LLC that owns that property. So a great way to own real estate again and get the benefits of that appreciation and the passive income without being a landlord. So for me, I mean, I think I just got tired of the volatility of the stock market and my 401k. I was taught growing up just to put my money, just save my money. And that's what I did. I put it all in a 401k, thinking like I'm the first one in my family to have ever had a 401k. And so I'm thinking I'm doing all the right things. And I think a lot of us do that. We're like, I'm saving, I'm investing, I've got a 401k and an IRA, and I do stock market. And then we realize somewhere along the way that that's not enough. My parents are now in their 70s and they're both still working. And I hate that for them. I don't want them to have to work. But sadly, that's a reality that a lot of people are facing, is we think we're doing all the right things. And then we not only can we not retire. I want to retire when I'm 55. I don't want to work until I'm 70. Do you? But that's where we're headed, is, if we're not putting our investments, our money to work in a way that's going to grow exponentially, that is where a lot of people are ending up. So, again, not selling you guys anything, but I just want to share this with other people like me that were looking for ways to put their money to work. So that's really it. That's all I've got as far as my little background info. But so I'm going to share my screen here. So bear with me for a second, because I'm working with dual screens, which is always a challenge. Oh, you know what? Let me see. How about that? I'm gonna check in on you guys. If anybody has any, I'm gonna stop this for 1 second and just see like if anybody has any, just to make sure if anybody's having any technical, like can't hear me or anything like that, somebody holler at me. But everything looks good. So I'm going to let me reshare that really quick so I can get back on track. Okay. So Here we go. Let's dive in. So, just disclaimer, the information provided is for educational purposes only. Don Keller, that is me, is not a CPA. I am not a tax advisor. I'm not an attorney. This information is not intended as and may not be relied upon as tax, legal, investment, or other advice. Now that we got that out of the way, I'm going to kind of skip over this too, just for the sake of time, because I want to really dive into our topic tonight. But this is just a little background about myself and my partners who I work with. And it takes the whole team to really to take down a big project like this. I'm going to skip this one as well, but I'll send you guys out the decks and more information if you want. But this is again just like about how syndications work and essentially what we're doing. But I kind of covered that. So let's dive into our topic: how to analyze a multifamily deal. So I hope that you guys have your coffee and caffeine ready because we're going to nerd out on some spreadsheets tonight. But no, I'm kidding. We're not really. I make this really simple. It's going to be super easy. But I want you guys. I get a lot of questions like, Dawn, like, what do you look for? Like, if you're either trying to buy your own multifamily deal, or if you are considering investing with another group with a syndication, and it's like, what are those key things that you look for? Because truly, like, a spreadsheet you can change in so many different ways that can drastically change the projection. So I want you to be able to be comfortable to be able to look at a deal and know like some key things that you're looking for. That way you can figure out like on like for yourself, like, is this something that if I'm considering investing in something, like, is this a deal that I think might be a good deal? So that's really kind of what we're doing here. So we're going to kind of, again, just kind of keep going here. What to look for. So we're going to cover these. I'm going to go through each one of these points like in a separate slide, but this is kind of like at a quick glance of what we're going to cover tonight. And here, let me start with this though. The back of the napkin, as they call it, just kind of quick and dirty. First and foremost, let's look at what is the property value. Like if you're looking at a property for yourself, or if you're looking at, again, like one to invest in, how do I even know what the list price or the whisper price, as they call it, is that even remotely in line with what the value is? Or is this seller asking like way too much? Is this realistic? Is this a good value? So the good thing about this business is it's very transparent. You should be able to easily get information, data like net operating income. That should be something that you can easily get either from the sponsorship team, the general partner team of a deal that you're looking at, or from a broker if it's a deal that you're looking at yourself. And then we're going to take that net operating income of that property and we're going to divide it by the cap rate. Now, the cap rate, again, is something that you should be able to either get from a broker, and the cap rate is very specific to the market, like sub market. It's not just, my properties are in Dallas, Fort Worth, but they're very specific to maybe like I have some in North Dallas. It would be very different than East Dallas. So you have to make sure you're in the right sub market for that. And they're all going to have slightly different cap rates, but you can either get it from a broker again, or you could probably even just Google it. You might be able to just find at least some general guidelines on what the cap rates are in the area of the property. So we're going to take the net operating income divided by the cap rate, and that should give us the value, approximate like purchase price, or what this property is worth. So here is a spread, just part of a spreadsheet, and we use a sheet that's like got several analyzer tabs on it. So this is just one screenshot. I didn't want to overwhelm you guys with too many figures tonight. So I tried to highlight every single thing that we're going to be looking at on each slide. So we're looking at net operating income. In this case, it's $728,000 for this particular property. This is a real property in Dallas. And then the cap rate is 4.7%. So if we divide by 4.7, that gives us a value of about 15.5 million. So that's essentially what this property is worth. So if they are asking 20 million for this property, we're probably not gonna get to a happy medium. So if you're in the range though, if they're, at 16, 17, maybe even 18, like there's some room there, like, okay, we might have we might be able to agree on a price, but that just gives you a really quick and dirty way to look at it. So 15.5 is a reasonable price to pay for this property. Next, we're going to look at the debt structure. So, super crucial that you get the debt structure right. Over the past couple years, we've all seen how interest rates have skyrocketed, and you can see that how a floating rate in that environment would kill a deal, right? So, there's some things that you're going to want to check out, like what's the term of the loan? Like, how long is it? What is the rate? Is that rate floating? Is it fixed? So in this example that we're looking at tonight, we've got 65% leverage, which means that's the money that we are borrowing from the bank. And low leverage essentially means lower risk. It's kind of like being like, if the problem, if you can do higher leverage than that for sure, and the deal can still work. The problem with going like too high of leverage is it's almost like being upside down on a car payment. Hopefully none of us have ever been in that situation, but some people owe more on their car than the car is worth. And that's exactly kind of the same thing. It's like if you've got a high leverage loan and then the market softens like we've seen in the past couple of years, the problem is that valuations of the property are going to drop, and then you've got your over leverage basically. So low leverage means you've got more equity in the deal, so that's a good thing. That's lower risk. And then you can see here we've got a 5.76% interest rate, and that is a that's low and it's fixed. It's a good, that's a good interest rate for right now for current situation, current environment. That's not bad. And then it's a fixed rate. So that also means lower volatility. Lower volatility with that fixed interest rate, it really just means like there's no surprises with fluctuations in interest rates. Everyone sleeps better at night. If the property is we know exactly what the mortgage is going to be every single month. And that's just helps everyone know that how the property performance, like interest rates, not going to affect that, right? And then of course, if rates come down in the next couple of years, like considerably, then you can always refi, right? And that next, rent growth. And there's a lot of things on this slide, I know, so I'll try not to overwhelm you. So let's start at the bottom. I'm going to start over here. I don't know if you guys can see my cursor because I'm using dual screens, which is always, that's always a problem. Okay. So the bottom left here, first thing we're looking at here is these are the pro forma rents, which essentially means these are the rents that we think that we can achieve once you've implemented your business plan. So that's going to be your property upgrades. This is going to be like amenities that you might add, or, oh, sorry about that. Amenities that you might add, anything like, if you're going to do like major, like you might be like you doing unit conversions, you might be doing like plumbing to install washers and dryers, whatever that looks like, these are going to be your rents post renovation. And so you might look at like 19% and you're like, Dawn, that kind of sounds like a lot. Yes and no, it can be. This is where it's totally going to depend on what is the business plan for this property and what are the comps. I think comps are probably the number one place to start, because if these rental rates are already being achieved in a property, like a similar property, similar vintage, like similar age, similar, size and amenities, if it's already being achieved in another property, most likely it can be achievable at this property as well. And then in the top part, I know that that's probably really hard to read, but I wanted to like show you guys all the figures. So I know that makes it really small, but I did try to just snip out. So the highlighted part that you can see, what it says there is the annual rent increases for the next 2 to 6 years. And so what that means is after we've done our renovations and everything, you're probably going to still have those rent bumps, right? Just naturally, especially in DFW, right? You just like every year, you're going to kind of continue to have that rent growth. And so what does that look like? So if you can't read it in the top highlighted here, you've got 2.95, 3.6, 3.6, 3%, and then 3% over the next 5 years. So what we want to do here is compare this to market data. There are great resources out there. We use CoStar and Yardi, and those are paid subscriptions and they're kind of expensive. You might be able to get access, well, especially if you've got a sponsor or a general partner that's presenting a deal to you, they should absolutely share that data with you. But you could probably also find some resources. I know there's tons of free data out there that you can probably find something similar, but we want to compare like, well, what should we be using? I mean, this is just a wild guess. No, it's not. It's really like, what are the projections? And CoStar and Yardi, their professional services, this is like what they do is market research, and they take into everything into account, your like like just like economic drivers, the population growth, supply and demand, just everything that's going on in that market, historical data, and then projections. What are interest rates, like all of the markets, and that's where they come up with these projections. And they tend to be conservative, but it's a great place to start. So that way you're not taking a wild guess. You're really using um, the expert data. So we want to compare that. If this is a deal that we're looking at considering investing in, then we want to make sure like, hey, is this in line with what all the industry experts are saying? So let's look at the gray box kind of in the middle where it says CoStar over here. So you can see like 2024 starting at the bottom, 2.9%, 3.4, 3.4, 2.7. So that's the projections moving forward. And then if you move to the right side, that bottom right there, starting with the bottom right corner, kind of going backwards, this is the historical 10-year. Historical tenure for, again, for this specific submarket is 3.9% average. And then you've got the box we just looked at, the average for the next 24 to 2024 to 2027 is 3.1%. And then the projection on this deal, our example that we're looking at tonight, is 3.2%. So is that in line with what Yardi and CoStar, in this particular case, CoStar is saying 3.2% versus 3.1% versus 3.9%? Yeah, I'd say so. I mean, that sounds reasonable. That sounds really in line. There's nothing out there that looks too unreasonable to me. And then rehab budget. This is not technically an analysis piece of data, but it is really, really important, especially since we just talked about how the rehab budget can make a huge difference, or the business plan and can make a huge difference on that rental increase that we were looking at, like that 19% rental increase. This is kind of where that comes into play. This is a huge factor, is what are we working with for our budget to rehab this property? When we come in and we do, let's say we want to do like interiors, we want to do new flooring and new cabinets, new countertops, but then exterior, we want to add some amenities. Maybe this property doesn't have a gym, so we want to add a fitness center. That's where this all comes in. So how are we going to achieve that 19% increase in rent? These are the factors. These are some of the factors, I should say. So, but there's a lot of variables that go into it. Like one I would say is the age of the property, the vintage, right? So, you might have like an older property it's gonna need a lot more work to get it up to the level that it needs to be. I should also want to mention just too that there should also be like a good pad in here too for unexpected expenses. I know we had a chiller that went out on a property, and that was $90,000. So if we had not had that pad in there, you're going to have that like extra. There's always going to be something, right? So you want to definitely have that pad in there. But unless it's a newer construction property that really doesn't need any work at all, I would say probably like minimum like 5,000 a door is what I would like to see for budget, like minimum. And then again, it's for like a newer property that really doesn't need any renovations at all. There's no major new construction. It's just kind of maintaining like upkeep and just maybe just adding some light touches here and there as units turn. And so that number increases from there, again, depending on how old the property is and what the plans are for the property. So in this case, with a $2 million budget on a, what did we say, $15 million, property is valued at 15 million, 15 and a half, $2 million budget over 124 units, that's 16,000 a unit. So that's a very, very healthy budget. So I feel comfortable, like that sounds like a really good amount based on the business plan of doing some major renovations to get this property up to the level that it needs to be. And next, economic vacancy. So first of all, like what is economic vacancy? Essentially, it's physical vacancy minus like, well, actually no, plus, including, so you got physical vacancy, and then you've got all of the other things that affect your total rental income, like concessions, loss to lease. This is when you offer specials on properties, or even bad debt, uncollected debt. If you might have an eviction, that money is like going to be uncollected. So you've got kind of like your gross rental income, and then subtract out the units that are vacant. That's your actual physical vacancy. And then anything else that would affect that rental income. Concessions, we offered, one free month, and then we had an eviction, and so that's going to come out of there, and then you end up with your net rental income. So economic vacancy is all those factors together. So what we're looking at here is really just again, that yellow highlighted there, just looking at the yellow part with the percentages. Don't worry so much about the dollar amounts, but just more the percentages. So when we look at this, we start out with 16.5 and then 9.2. This is actually past performance before an acquisition of a property. So the past 12 months and the past 3 months is what that means. So 9.2% is where the property would be sitting like right now at 9%, 9.2% economic vacancy. That's really good. That's considered like a stabilized property. That's great. Well, I should say for DFW, for this North Dallas, for this pocket that we're looking at, this submarket, it definitely is going to depend on what market you're looking at. But then you see the next one, it goes to 20%. Like, why did it jump? It like more than doubled. And that is because you're going to expect when you put in $2 million into a property, our renovation budget, and then your plan is to increase rents by 19% after the renovations are all done. You will have some turnover. I mean, that's just a fact. You're just going to have some people. Now, we're not kicking anybody out. We're not, but as units come open, as their lease is up, then they have an option. Like, do they want to renew or not? And some people will not renew because it's just not a good fit for them anymore. So you will definitely have some turnover, but then you can see it kind of starts tapering back down. So then you go to 17%, 13%, 10%, and we get into this like 10, I'd say like 8, 9, 10, 11% range is like considered like stabilized. Like you're in a good place where you've stabilized that property. So that would make sense, right? That's the whole goal, is to get back down to there. But we're definitely going to probably expect a lot of turnover at the beginning. If I were to look at a property and say this 9.2% at takeover, and this number, the next one, there's 20% there. But if that number was around the same as 9.2%, I would question that. That is very difficult to do with this much of a change of a property. So that would be concerning. So 20%, that's an assumption that is going to be really conservative, in that we're going to have a 20% economic vacancy. But again, let's just compare it to CoStar. Let's just see what CoStar says. So for 2024 through 2027, you can see that there's pretty low figures in here: 8.2, 8.7, 8.9, 9.1. None of our numbers here in our example really get to that low. So the lower means that means your property is really stabilized. So the higher that number is going to be more conservative. So we definitely are under, in our example here, we're under really what CoStar is saying. So that looks good. That looks conservative to me. And total income. So kind of the same thing on economic vacancy. I'm just looking at the percentages more than the numbers. And this kind of the same concept here is these numbers, the percentages should taper down. It starts at 7.7, 8.3, 7.5, and then it tapers all the way down to 2.9. And that again is because we're expecting most of our growth. I mean, total income is really just like, it's the total growth of the property, right? The total income. It's okay to see, so you might see some double-digit numbers in these first couple of years. That's okay, because again, when you're really transforming a property, that's going to be expected, that most of your growth is going to be up front. And then again, when the property stabilizes, you're not really doing much to the property. You're not putting any in $2 million. That's already done. So now you should just be seeing the benefits of just that like gradual increase, right? So just make sure that those kind of taper out just to be conservative once that property is stabilized. Expenses. So here we are comparing the current expenses on the property to what like the pro forma expenses. So these things may change because you're going to have a different business plan for the property. You might be putting on a new property management company. All these properties are managed by a third party professional management company. And they may change a little, but my caution here is I would look at anything that is lower than the current expenses. I would want to know why. I would want to know how and why that's going to happen. For example, you can see in payroll right here that payroll is currently at 216, almost $217,000, and it goes down to $152,000. So, I mean, how's that going to happen? In this particular case, this property was overstaffed for the size of the property. And you can kind of even see a little bit like there's like a little cheat sheet. So in the green circle there is kind of a little cheat sheet that shows you, this is just a suggested range. Again, it's going to change. It's going to vary quite a bit. Doesn't mean you have to stay in this range, but just as a general gauge, it kind of helps as a little cheat sheet guide. But you can even see that like the payroll between 900 and 1200 is reasonable. But this property is operating at almost 1750, it looks like. And talking with a property management company that you would have on this property, they're going to evaluate this and say like, yeah, this property is probably overstaffed. We can definitely reduce the payroll expenses. So that's where that number is going to come from. But anything that you see that just looks like these are all good. So going from 45 to 63, we've got, you've got extra budget in there, utilities, but anything that you see that's like, well, how are you going to reduce your expenses by that much? I would definitely just ask, or if this is your business plan, then it's got to be realistic. Like, how can you achieve that? Is that doable? And then verify it. And you can see at the bottom here, total operating expenses is pretty much the same. It's a difference of $10,000 in there. So that seems reasonable too. And then just a quick tip on expenses in general. Expenses, I think, should be like roughly about 55% of the total income of the property. Again, going to vary with size. Sometimes it's easier to spread your expenses out over a larger property because you've got economies of scale. So smaller properties might have a higher ratio of expenses. That's very common. But I would say even at a minimum for larger properties, I'd probably say like not less than like 50% of expenses. So just again, kind of when you're doing like back of the napkin, quick math, make sure that those expenses are realistic, that you've got a budget for, 50, I'd like to see 55, maybe 50%. And that's net income. So not gross, just to clarify that. So we're talking about net income, and then 55% of that net income. That's kind of a good, just a ballpark, a range of what to expect for expenses. I'm guys, I might run over. I know I was really trying to keep this until we were so close. We were almost done, but if you'll hang with me for just a couple more minutes, if that's okay. If not, I will, did I record this? Yes, I am recording this. I think, I hope so. And I will send you the recording. If not, I will send you the decks. If I know some of you guys have to pop off because I did promise we would keep this to 30 minutes as best we can. But, so this is reversion cap rate. And we talked about cap rates at the beginning, right? Which is the ratio of the net operating income and the value of the property. And this is reversion cap rates. This means like, well, what do we think this property is going to sell for at the end? Like if we're planning on a 5-year hold on this property, what does that look like? And again, we're kind of really heavily rely on that industry data. CoStar and Yardi, they look at historical data. They look at things like, we talked about this, like supply and demand. They look at population growth, interest rates, look like 10-year treasury. They take all of these economic factors, everything going on into consideration when they make these projections. And also historical data too. So you can see at the bottom left here that I've got circled that 5.25 on this property in our example, and that's the reversion cap rate is 5.25. And then if you look at the top right, that's circled there 3.98, so like just 4%, that's the historical cap rate from the past 12 months. And I'm not even sure if I explained what cap rate is. If I didn't, I'm going to just pop it in right here. That the cap rate, I know I've explained the formula, but the cap rate really is essentially like what are properties going for right now in the market? What are they selling for? Just like that's because that changes all the time. So that's just like a general, like this, we're seeing 4%, we're seeing 5%. Like what are properties selling for right now? So that's really what that means. So over the past 12 months, it's been 4%. Now you can see down below that, you can see, well, what does it look like moving forward? You can see that it increases. It goes 5.8, 5.6, but then it starts dropping back down, 5.3, 5.1. So let's say this property, when we buy this property together, that we are looking at selling this property 4 or 5 years down the road. And let's say 2027, we could probably expect to be around a 5.1% cap rate. That's great. So in this scenario, we've put in a 5.25. So that is actually a little more conservative than 5.1. And I'm going to try to do something because that really is the last little bit that I wanted to share, but I wanted to show you guys the actual spreadsheet that we're looking at here. So I'm going to stop this for a second. And because I wanted to show you guys if I can do this. Let me see if you guys can see that. Okay, so you should be able to see a spreadsheet now. And I'm gonna have to, because I'm using dual screens, I'm gonna kind of be looking at this screen now. So okay, so this is the actual the whole spreadsheet that we've been looking at this whole time. I was just taking bits and pieces so we can kind of look at each section. But you've got this is where this came, the 5.25, but I'm going to show you how much of a difference this makes. When I go to this tab here, you can see that right now, as it stands, everything we've looked at tonight, this property would come out to be a 90%, right at 90% return for investors. So a 90% return essentially means a 1.9x. So a $100,000 investment would mean that everything pans out like this, it's going to be $190,000 return, your original $100,000 investment back plus another 90,000. So that's what that means. But let's look at what if we did change that to 5.1, which is what CoStar had. Just changing that one cell. I hope you guys can see this. Okay. Can I move? I'm going to zoom. Yeah, maybe you guys need that. Maybe you can see that better. Sorry about that. Okay. So I zoomed in a little bit, so hopefully you can see it now. Now it goes to 98.4 or 04, 98%. It went up 8%. I mean, that's $8,000. I mean, so that changed just changing that one cell. And then you can play around with that, right? So, what if it went to 5%? I mean, that's pretty close to 5.1%. Now we're at 103% overall return. So, and then it goes the other way too. The flip side is, what if it goes to 5.5? Then we're at 79%. Okay. So it's going down. So that's just changing that one cell can change everything like drastically. So this is something when you're looking at a deal is to not only stress test your own deals, but if you're looking at investing in a property like this or like in a syndication, then your sponsor team should be doing stress testing like that. And to even show you, like what if what would be the worst case? Like what if this increase to 8%, which I mean, Dallas hasn't seen 8% in I don't know how long, probably before I was born, but so 8%, let's just say, what does that do? Okay, so now we're at a 3%, right? So basically a break even, right? So that's how drastically, like, I mean, Dallas to see an 8% cap rate is, I mean, that's astronomical, but that's what would have to happen essentially. Now there's other factors too, right? Because we built in this whole business plan here, but that just shows you, I just want to show you that quick example so that way you guys can see how much each one of these factors is so important. I'm going to go back to my other slide here, just get screen sharing. that work? I hope so. Okay. I don't think, yeah, I think you guys can see it. Okay. So, that just shows you how just like changing one cell though. It's like so important to look at all these factors when you're evaluating a property, just because one cell can change the whole projections drastically. So that is really it. I was going to go through these tonight. I know already over time. So thank you guys for sticking with me just for a few more minutes. If you are not familiar really with multifamily and just like why people invest in multifamily, these are some of the reasons, right? You get steady cash flow, you got passive income, strong demand, stability. We love that. Tax benefits, great tax benefits. Hopefully, the Senate is going to pass the bonus depreciation for any of you that have seen that, been watching that. Appreciation, inflation hedge, economies of scale. And these are just some of the reasons that we love investing in multifamily. This is why I started investing in multifamily. It just checked all the boxes for me. So just wanted to share that with you guys. But that's really it for tonight. I will just leave you guys with this. I think that we work so hard for our money. And I know I do, and you deserve the best for you and your family. And really what this is about is it's buying back your time. It's putting your money to work so that way you have more time. You're not tied to your job and that's, your life until you have to work until you're 55, 70, or like 70. You don't want to work until you're 70. Um, this is creating a better life. This is like buying back your time so you can spend time with your family or traveling or doing all the things that you love to do. And multifamily really has helped me get there faster. It's really helped me build that passive income so I can achieve that financial freedom. Really, financial freedom is about time. It's not really about money. It's about buying back your time. So, um, if you guys would like, feel free to scan the QR code on your screen. And what that's going to do is just bring you to a form, just a simple Google form. If you're interested in setting up on like a one-on-one call with me, just to ask questions, or if you want to just learn more about multifamily in general, I'm happy to help. Love to be a resource for you and help in any way that I can. There's an option to just do a scheduled one-on-one call, or if you just want to be added to our list for other upcoming webinars or education events, anything like that, just note that on the form and we'll reach out and connect. But I hope this was helpful for you. So I appreciate you guys so much for coming out tonight and spending time with me. I wish you guys all the best. See you next time.